Hello, everyone. Welcome to today's session on moneyness in options trading. In this video, we will understand the meaning of ITM, ATM, and OTM options. Moneyness refers to the relationship between an option strike price and the current market price, spot price, of the underlying asset. It helps determine whether the option has intrinsic value and whether exercising the option would be profitable. In options trading, moneyness is classified into three categories: in the money, ITM, at the money, ATM, and out of the money, OTM, based on the comparison between the strike price and the prevailing market price of the underlying asset. Now let us understand moneyness in call options. Call options are generally purchased when traders expect the market to move upward, which is known as a bullish outlook. And in the money, call option means the strike price is lower than the current market price. Since you can buy the asset at a cheaper price than the market, the option has intrinsic value. And at the money, call option means the strike price and market price are almost equal. There is no intrinsic value at that moment. And out of the money, call option means the strike price is higher than the current market price. Exercising such an option would not be profitable immediately. For example, if Nifty is trading at 24,600, 24,000 call option is ITM, 24,600 call option is ATM, and 25,000 call option becomes OTM. Let us now understand put options. Put options are generally used when traders expect the market to fall, which is called a bearish outlook. And in the money, put option occurs when the strike price is higher than the market price. This creates intrinsic value because you can sell at a higher price than the current market. And at the money, put option has the strike price equal to the market price. And out of the money, put option occurs when the strike price is lower than the current market price. So it has no intrinsic value. Using the same example of Nifty at 24,600, 25,000 put option is ITM, 24,600 put option is ATM, and 24,000 put option is OTM. Now let us understand the important characteristics of moneyness. The first concept is intrinsic value. Only in the money options possess intrinsic value because they are already profitable to exercise. At the money and out of the money, options generally have no intrinsic value and mainly consist of time value. The second point is premium cost. ITM options are more expensive because they already have value. ATM options are moderately priced. OTM options are the cheapest because they depend completely on future market movement. The third point is risk and reward. ITM options are less risky and have a higher probability of success. OTM options are highly risky but can generate very high percentage returns if the market moves sharply. Let us now look at a practical numerical example using Nifty. Suppose the current market price of Nifty is 24,600. If we take a 24,000 call option, intrinsic value becomes 24,600 minus 24,000, which equals 600. Therefore, it is an ITM call option. For a 24,600 call option, intrinsic value becomes 0. Hence, it is a TM. For a 25,000 call option, the calculation becomes negative and intrinsic value cannot be negative. So it is treated as 0. Therefore, the option is OTM. This example clearly shows how moneyness is determined in real market conditions. Finally, let us understand the put option example. With Nifty at 24,600, a 25,000 put option has intrinsic value of 400. So it is ITM. A 24,600 put option has 0 intrinsic value, making it ATM, a 24,000. Put option gives a negative value, which becomes zero intrinsic value. So it is OTM. To conclude, moneyness is a very important concept in options trading. It helps traders understand option value, risk, premium pricing, and probability of profit. Understanding ITM, ATM, and OTM options is essential for selecting the right trading strategy. Thank you for watching. Keep learning and keep growing in the world of financial markets.